Good morning. We'll start the session in next 2 minutes as people are joining. Thank you. Hope the screen visible, right? Okay. Good morning, India. I think we have been doing this webinar for last 2 years. Broadly speaking about how corporate India, particularly Nifty and BSE 500 companies are declaring numbers, because we strongly believe over a long period of time, the value for an equity shareholders comes from corporate India, and it's very, very important that we continuously monitor this progress every 90 days, right? So thanks for joining. Hope in next 45 minutes, I will run you through quickly the mega trend which is driving the corporate India, the commentary from corporate India, and followed by numbers both from Nifty as well as BSE 500, which covers close to 90% of the entire India market cap. And then finally, in terms of how is the current market setup, right? In terms of what caused the fall, and then why we are turning slightly bullish in market, right? In terms of large cap and maybe a selective mid and small cap. So that's a context setting. So the topics we will cover is mega trends, corporate commentary, numbers, and the overall setup of the market, including a couple of view on sectors. So the mega trend which is driving corporate India is India's GDP, right? I think obviously we all know what has happened to Q1, Q2, possible Q3 GDP, right? I think it's been getting slower, and Q3 was a little better than Q2, right? But what is also very important for as a long-term shareholders, as a long-term equity investor, is to look at the big picture. So we moved clearly from a very small economy 25 years back from a 38 lakh crores. We moved in a decade close to 87 lakh crores. Last year we have ended, or this year we are ending at 324 lakh crores. And the big picture is when this 324 becomes 1000 lakh crores, right? How certain new sectors will emerge. There will be new companies will create. Existing great ones also create value. So I think the big picture is India, the largest stock, if I were to consider, has grown at 10% CAGR. So as a capital allocator, we consistently communicate India has delivered 12 to 13% CAGR return in Nifty in INR terms. And that has primarily come from the economy itself has grown at 10%, right? So that's a number So those who are very pessimistic, keep this number in your view. This is one of the large economy in the world growing at a very healthy double digit in nominal GDP growth. Coming to the followed by GDP, right? It's eventually how the earnings of the corporate for the last 20 years. If you look at the picture here, it is 12% compounded growth rate, and the Nifty value is also compounded at 13%. So clearly, over a long period, I think this is the beauty, right, of the market. Market follows the earnings, and in this webinar we will continuously going to talk on how the earnings are getting captured, right? I think so we have to keep this in mind. So in the short term there will be so much of macro concern, so much of tariff, all this news which can rattle the investors. But in the medium term, 4 to 5 years and above, right, all it matters is, did we buy a good company where earnings are going to rise, and did we not overpay? And eventually, I think once market stabilize, the price reflects the value. Why we choose to do BSE 500 is, even though there are 5,000 odd companies are listed in India, this 500 company, which is so overall BSE universe, which is all company put together, is 394 lakh crores. But BSE 500 alone is 350, 347, right? Which is roughly 90% of the entire listed universe of India is captured by BSE 500. So if we cover very good work on BSE 500, we have almost covered 90. That is a very good job to be done. Having looked at the mega trend of India's GDP, how corporate earnings have grown for a longer period, how BSE 500 is relevant, now let us take some evidence about what was shared in the call, recent commentary by the larger corporates. So starting with the L&T on Indian economy, I think clearly corporates have called out the slowdown. If you see closely, right, the growth momentum of the Indian economy has waned a bit in recent quarters. Basically, urban consumption is down because of excess savings from the pandemic has been exhausted. And the lending norms of NBFC is also tightened, right? So these are the two causation for the urban slowdown. Rural consumption, on the other hand, is showing some healthy uptick because of agriculture activity. But another cause of concern is the public investment has slowed down due to past elections. But the good news is economic activity has possibly bottomed out and could recover in the back of improved government spend. I think Q3 GDP clearly reflected the trend is slightly rising, and that is what L&T precisely called for, where we have seen the worst of slowdown from the economic growth point of view. We strongly believe in the next 6 months to 1 year, the growth rates will accelerate. We are not going to go to 8% growth, but I think we are not going to be at a lower end of the 6, right? We are going to go very close to the 7. I think that trajectory will give a lot of positivity in next 6 to 9 month point of view. Coming to international, I think it's a tough environment. I think 2020 post-COVID recovery to 2024, even though there was a tough environment, there was a lot of liquidity. People made a lot of money, right? But I think environment is getting tougher with the new government in US. Definitely, it's getting tougher by day. So military conflicts, but likely to go down. Political landscape has changed tremendously. And another reason, which I think we have to keep in mind, post-COVID government balance sheet is impaired because of a lot of debt. So the incremental growth coming out of fiscal policies is going to be less. So that is the constraint, right, in which we all are operating. Coming to India, again, going back to India, rural demand and urban trends, I think urban consumption is slowing down very clearly. India's largest consumer name is calling out, and urban is continued to lag the rural. A very interesting piece on inflation. I think corporate India is also, it's been a very volatile operating environment for corporate India. We have to appreciate when they miss numbers. I think the context is very important. I think Britain has captured very brilliantly, saying we have been going through a phase of inflation, then a deflation, then an inflation, then a deflation. So to the beginning of the year, they thought this is going to be not an inflationary economy, but suddenly I think food inflation spiked. and they are now started increasing the price of the product, right? So I think we have to give some merit to corporate. The environment is so tough, the planning is becoming very, very challenging. And then to go back on your plan, it's even more bigger challenge, right? I think that is why a couple of corporates are not able to guide well. So what happened now is they're not even guiding. That is where the market disappointment is coming in, because you're not getting the clue of what is expected out of corporate India. So coming back, having seen the mega trend, having seen the commentary, now let's see what is the corporate India numbers. So first I'll talk about Nifty 50, which is roughly right. So corporate India delivers close to 16 to 17 lakh crores of profit per annum. And Nifty 50 does around 8 to 8.5 lakh crores. So close to 50 profit comes out of Nifty 50. So we will speak on Nifty 50 and then we follow by BSE 500 and then subsequently on other things. So this is a very interesting data. We update every 90 days is the 10-year track record of the top 50 company with the TTM profits. Basically, this is December ending TTM profit. If you look at close to 25 to 27 companies have reported their all-time high profit just ended December quarter, right? So those are very, very pessimistic. One thing you have to keep in mind, corporate India is delivering. Maybe the rate of growth has come down, but they are reporting their all-time high numbers, right? So if you look at SBI, if you look at 17, 18, this is where the weak period of SBI happened, where negative 4,000 crores. And I think last 6, 7 years, they've significantly scaled up. And today, SBI is the number one corporate, which is listed corporate, reported profit TTM, 80,000 crores. And we have 4 corporates reported more than 50,000 crores of profit on a TTM, which is 12-month basis ending December, which is State Bank of India, Reliance, HDFC Bank, and ICICI. Clearly reflecting the profit pool is dominated by the banks and actually well represented even by the index. If you see, right, a lot more companies are reporting their all-time. And if you look at the total profit, right, the March ending 2024, we had 8.24 lakh crores of profit, which was close to COVID, was close to 3 lakh, right? So we moved significantly from a 3 lakh crores profit pool to 8 lakh crores profit pool in this 4-5 year period. So the growth rate was very significant. Valuation re-rating was significant. I think a lot of money was made. Now the growth rate is slightly tempered down, right? I think we are going to grow close to 4 to 5% during this year. So this is 1 year where corporate India is going to hit all-time high profit aggregate, but the rate of grew to 5 to 6%. And that was the first setback happened, which led to the market fall. But if you look at, interestingly, the last corporate, right, on 50th Nifty is 1,241. So when we say we do have some exposure in mid and small cap, right, given the valuation concern, one thing we have to keep in mind, there are a lot of large mid-cap companies out there, which is part of mid-cap index. So what I thought this time is I will put out this data on Nifty mid-cap 50 stocks, 10-year track record, similarly, right? So if you look at the large company, which is Indus Towers in the this one has reported 10,000 crores of profit TTM. And if you look at many companies have reported their all-time high, right? So clearly reflecting, it is not very, very small companies, right? So there are many company more than 1,000 crores of profit pool are part of mid-cap index. So one thing is definitely we have to look at individual idea based on where they are in the growth curve, where they are in the valuation. Sometimes bucketing everyone into one segment and saying, right, this entire indices is weak might not give you a real picture. And if you look at Nifty mid-cap ideas, right, there are close to 30, 35 odd companies are either in top 1, top 2, or top 3 in the respective segments, right? So clearly they are market leaders and they are reporting also all-time high profit. So that's just a point I want to bring in. Going back to Nifty 50 numbers on December quarter, this is the growth range. So out of 50 company, I think because of GDP growth has slowed down, very interestingly, if you can see, the bulk of the corporates have reported sales growth, which is the most important driver in my view, has between 0 to 10%, which is 18 companies, and 10 to 20%, 19 companies, right? So there is only 5 company which has grown faster than like 20%, right? Which is more of an exception rather than a rule. And this is more a lot of financial services have given this. And if you look at 8 company have reported negative sales growth, clearly reflecting that weakening GDP is reflecting brilliantly in the Nifty 50 numbers. But if you look at profit, right, what is helping us little bit better is I think corporate is able to find little more efficiency. They're able to pass on to the pricing, right? So there are 15 corporates have declared profit growth more than 20%, right? Unlike if you look at sales, which is only 5. So clearly reflecting it is not everything is bad. Those who want to be very, very pessimistic, I think this data clearly demonstrate profit pool is across, right? So there are corporates which have declared good numbers. There are corporates which has declared very weak numbers, right? So coloring them in one picture might not give you a great perspective. Going to having seen the Nifty 50, now let's see how BSE 500 numbers are playing out. So broadly, the sales growth of BSE 500 is 6.7%, right? I think this is where the pain point. Again, if you look at large caps have grown 6%, small caps have grown 6%, mid caps have grown 10%, right? So when you double click data, there is always some pockets of segments are growing, and that is where sometimes the opportunity opens up in such markets. When again you go back and see how it has performed by various sectors, right? Very interestingly, even though it is 6.7%, the big sector like oil, crude oil has not grown. If you look at insurance has not grown, iron and steel has not grown, right? So if you remove these three, I think broadly this number goes to 9%, reflecting what India's GDP growth, which is close to 10%, right? So again, we have to go by sector by sector. If you look at banking has done 11 to 12%, which is far significantly higher than 6.7. IT is very close to the market growth. Automobile, again, a very large sector, slightly better. Finance extremely well. I think this number will accelerate with RBI now easing more. FMCG, at least from the top line point of view, have grown. Definitely, they lost a lot of margin. Healthcare also did a decent job. Again, right? So if you look at the primary large 5 sectors, FMCG, healthcare, banking on the top line did well. IT and auto did not so well, right? So that's a context. The rest is a lot of noise. You have a lot of sectors that are degrown and few sectors have grown very aggressively, like telecom at close to 20% primarily because I think they are having a phenomenal run both by Bharti and obviously in Jio it's capturing a bit. And the overall sales is 38 lakh crores, so which is 6.7% of growth. Now, if you look at PAT, right, which is the most common, very important thing, the aggregate PAT growth is significant, 18%. Obviously, there are one-off. If you remove one-off, one from Bharti Airtel close to a few thousand crores of Indus Tower, which got added back, I think this growth rate will be close to 13, 14, but still much, much better than the sales. So large caps have grown at 16%, which is all numbers put together. Mid cap have grown aggressively. One interesting outcome, which is against the market narration, I would say, is small cap aggregate index profit pool has been consistent with close to 26,000 crores, right? Unlike the general view, right? Small caps are growing, they're growing at 20%. Most of the small cap are high growth stocks. Not necessary, right? I think there are good growth company in large cap. There are weaker sales growth company even in small cap. So that's a perspective which I would like to share. Again, you double click and see where the profits have come. The 4 lakh crores, which is an 18%. The big profit growth has come from financial services. Banking has grown at 21, significant growth. Finance 22. In line with the same, oil and gas has not done anything. It's a cyclical sector. When they revive, you will see a lot more revival in EPS growth. Automobile is struggling. I think automobile, we currently believe, is in a mid-cycle where the easy run post-COVID has been done. Now I think they will go through a phase of consolidation and then eventually post-budget consumption boost and eighth pay commission and so on and so forth and overall economic activity. This sector can grow in the medium term, but I think this year is more going to be a consolidation year. As I told, telecom numbers are slightly aberrated due to there is one-off profit. Otherwise, it will be much lesser, but definitely higher than 4,000 crores, which was reported in the last year. And if you look at again on the number of count, right? This is another important metric we track is it our number of companies are delivering the profit. So out of 498, which has reported numbers, and one doesn't have year-on-year number, one yet to report the number. So 209 companies have reported profit growth of close to 20% or above, against 181 company have reported negative. So clearly it's a barbell. So corporate India, in a broader sense, have delivered either very superior growth or very inferior growth, right? So that is where you see portfolio performance are now getting differentiated. It's no more an easy run. We have to be very, very careful about how you build the portfolio, how you size the portfolio, and what you expect out of the portfolio, right? Where will become even more important. So clearly, there are 250 odd companies have not done anything great, and 250 odd companies have done reasonably good growth, right? So it's a very divided market, and I think it's going to get even more divided as we progress along. So to end on the corporate India performance side, this is our famous slide, which we consistently say, right? Opportunity, answer is yes. Is there enough place where corporate India has already delivered where value cannot be created? Answer is yes. So the green shaded one, right, which is where the numbers are extremely solid. Both top line have grown close to 10% and above, and bottom line have also grown more than 10%, right? So this is the box where ideally anyone's portfolio should be there at this point in time. Hopefully, right, the price correction would have been very, very less. And those who want to invest, we always look for buckets like this, where the current operating environment is weaker, reflected both by sales having a negative growth. The 70 reflecting, there are 70 company out of BSE 500 reported negative sales growth, negative PAT growth, right? So definitely their operating numbers are very weak, and most probably the price also would have corrected badly, right? But this is the window which gives you opportunity if you want to allocate capital. So we allocate capital here, and we actually end up moving the stocks here, and then the selling happens here, right? So that's the beauty of this quadrant. So there are 16 boxes reflecting 16 types of an opportunity within the market. So having seen the mega trend, having seen the overall commentary, and having seen the numbers, right? So now let's go and see what has happened in the last 6 months in terms of market perspective, because I think it's been a brutal market. People have experienced multiple cycle also. The Jan to Feb fall was very severe. So I thought, let me share our perspective, what happened and how we think it can unfold. The first thing is a very interesting data came from Morgan Stanley's. Very unfortunately, this time we had in the last 1 year both fiscal tightening and the monetary tightening. So if you look at one way to keep the fiscal deficit low, the government kept the constraint on during the last year. The capex, which used to grow 30-40%, that created a lot of bubble in some stocks in defense all, literally crashed. So people knew this crash coming in because of election. But what was the assumption was the market will recover like a V shape, very straight up. But what it happened, it took a lot of time to recover, and there was another bump here. I think this created the slowdown little more longer. Now the growth is coming back, but I think this longer period is where current pain has got reflected. That's one on the expenditure side from the government. From the overall tightening of the policy by Reserve Bank of India, rightly so, given they want to create a longevity of growth, the impact was seen in the unsecured consumer loan, which used to grow 30-35%, has came down to close to less than 10% during the last quarter, right? I think this decline also caused some bit of a growth constraint. I told, right, fiscal deficit. So government wants to bring the fiscal deficit down from 5.6 to 4.8. This is what caused them to reduce a little bit of expenditure growth to keep the fisc in order, which is a long-term positive, but short-term negative. So given both the impact of fiscal and the monetary, what happened to the EPS is there was a steady decline in the EPS estimate. And I'll tell you how to read this chart. The orange is the LHS left hand side, and the other one is in the right hand side. This one, right? So basically, if you look at 26 earnings, we started at 1300, 1300. Now we have declined close to 1240, right? So close to 60-70 rupees of a decline has happened for the FY26, primarily reflecting the market fell. But before market fell, the actual estimates of earnings also fell. So when people look at the fall, we have to see components. One component was the EPS estimate got revised downward. The other component was valuation become little more affordable, or PE got derated, right? So the market setup during the September when this all was happening was the quality of the balance sheet, which we all see, right? If market has to go up, these three pillars are very important. The first pillar was extremely solid, right? Both banking and corporate balance sheet. The pain point was valuation, and definitely the bigger pain point was growth. So market was not prepared for such a slowdown, given valuation was reasonably high and growth was slowing down. This caused the market to fall, right? So you had an earnings cut with higher valuation, was a deadly bad combination, which resulted in the market fall. So we fell close to 11-12% on the Nifty. If you look at midcap, small cap, and equal weighted, right? So equal weighted has fallen 15%. So clearly reflecting the larger 50 companies have fallen 15. The smaller ones have fallen between 20 to 25 at the index level. I'm sure at the stock level, the fall is significant. There are like at least 50% of the BSE 500 have fallen close to 30-35%, right? So clearly reflecting the pain is broad-based. So this is again another data, right, to reflect the fall has been very steep. But if you look at some sectors have fallen the least, right, where the profit has been growing steadily and the valuations are attractive, like banks. The top 10 Nifty companies have done very well job. Pharma has done well job, right? So this is where when we keep reconciling the corporate numbers and the valuation, right, you know, when the risk environment gets higher, the people who are delivering, they will have a lesser fall. Obviously, they will also will fall, but they fall less. Vis-a-vis, if you look at couple of thematic or factor index like reality alpha, 35, right, really reflecting those who believe index is non-risky, right? So definitely some index are a high beta index. They do extremely well in a bull market and they will fall extremely sharp in a bear market, right? So equal weighted Nifty is 10% and couple of index within thematic or the Nifty alpha is 30%, reflecting 3x beta, right, in a down market. So I think we have to be very cognizant. We allocate capital. What are we getting into it? What is the risk and how do we play it? So is the fall is only in small and mid cap? The answer is no. The beauty is it is not even left even the blue chip. So this is a drawdown analysis of the two blue chip company, Bajaj Auto and TCS, is a random example, but they both are Nifty stocks, both representing debt-free company, very large name and very reputed name with a 20 years of track record, right? But if you look at Bajaj Auto has also fallen close to 40% and TCS has fallen close to 25. Historically, if you see, TCS generally falls close to 20, and this time also it has fallen 20-25, right? Reflecting, I think, a lot of opportunities opening up as we speak. So this fall doesn't mean tomorrow morning we end up going and thinking about buying some of the names, right? This fall means the risk is coming down at the market level. If you are a medium-term investor, I think we have to keep looking at where the price is attractive and the growth is getting better, valuations are better. I think that is where the opportunity will open up for a medium-term investor. So what has changed, right? We have seen the fall. Now, I think the last question which everyone's mind will be, what has happened post-September till March as of now, right? The first thing is sentiments. Clearly, we moved from extreme greed. So there was a point in September or August, if we have to speak to people and say, right, we have to go and sell, so much hesitation, why we need to sell, market is trending, there is so much of retail money, retailing, right? But valuations was clearly telling the risk to reward is turning unfavorable. Now, the good news is we have moved to a fear zone. I don't think we have gone to extreme fear, but definitely looks like we are in a fear zone. People are worried about what will happen with Trump. People are worried about what will happen tomorrow. So those who are thinking about 10 years now thinking about tomorrow, right? I think this is a very good starting point in my view. If you are want to allocate capital into Indian capital market, I think this could be a very good point to start looking at data very objectively and then take a good capital allocation decision. Growth initiative, right? So once the fear has come in, which is a good positive, second, growth initiatives. The first thing is monetary policy from tightening to easing on three front. Rates coming down, liquidity is improving, regulations are getting better. So monetary policy is now favoring the growth vis-a-vis against the growth some time back. So that's point number one. Budget clearly has reflected the support to consumption, which we are all experiencing and going to experience further. NBFC credit growth is expected to grow post the risk weightage reduction by RBI. The recovery in government capex is already happening, but at a slower rate. And finally, you see there is some more noise coming out of the disinvestment, which is IDB and LIC and much more. I think all this will create a better growth data in next 6 months to 1 year. And I think that is what every equity investor should look forward. Third, the earnings downgrade cycle got accelerated in the last 12 months, which is very good news because currently the assumptions are realistic. So if you look at the earnings downgrade, which is more than 5%, it was 8.3% of the company out of Nifty 50 had a downgrade of more than 5, which moved to 16. In the recent days, it's gone to 26. Basically, significant downgrades is already in the bag. The market now is going down. And the fourth good news is, as I told, post-COVID, we had a very steep earnings growth cycle, right? A very solid 4 years of earnings growth cycle. The disappointment came here, naturally so because of a high base. Now, FY26, which used to be 20% earlier, now post all the revision is close to 13, 14. Maybe we think the Indian corporates can do between 11 to 12, if not 13, 13 and a half, because IT is going through slightly downward revision, but still far, far better than 25. So one thing is pretty confident today, given the environment, FY26 EPS growth is going to be better than 25, at least by 5 to 6% more, which should start supporting the market, right, as we go by time. The last one, the large cap valuations have turned very, very attractive post the correction. Today we are trading close to the valuation, average valuation are slightly below. I think these are numbers which is keep volatile, but definitely we are not in a frothy zone in large cap. I would say the risk to reward is getting very, very favorable in large cap. And I think those who have 4 to 5 year outlook, definitely this is one space where the entire space is getting opened up to allocate a lot more capital. The last one, supply is reducing from the promoters, right? So we saw heavy supply of stock during the last season, which in the last couple of months have come down, which is good because once you don't have supply, eventually, right, market gets stability. And one of the very interesting data from overall macro also, the service export, which is a very non-volatile export, which is consistently growing and come very close to the goods export. I think in the next 6-7 year story will happen where goods will be very cyclical growth. So there will be a phase of the service exports is going to be a larger export driver, which is one, a very solid growth and less volatile, right? So I think India's story is going to only get better in next 3 to 4 years. So to end, the market setup, what has changed, why we are a little more bullish today? Market setup 6 months back was in slightly not favorable because I told, right? One leg was very good, other leg was not great, and one was getting bad. But today, if you have to look at, I think the setup is much, much better, definitely in large cap and selective mid and small cap. The quality of the balance sheet is extremely good. I don't think corporate balance sheet ever been so good like what we are there in 2025. So people with a 5 to 10 year outlook, this is the biggest driver, right? So corporates are well positioned today to grow the entire P&L using their balance sheet. Valuations are getting better post this correction, and growth outlook from a severe red is getting into an orange zone, and it's getting better. I think in next 6 months to 9 months, we believe this orange will become green. And I think hopefully, right, you're not going to get all green at one shot. So if you are an investor, right, you need to think about once you get 2 out of 3, right, generally it's a very good time to allocate capital. I think time has come from people who have 4 to 5 years outlook and have more capital. This could be a very good opportunity. We have seen 5 years back during COVID, a very similar confusion created the price correction. But I think very few people used the correction to build into a good portfolio. I think the market is giving you one more window. Maybe the recovery might not be very close to what COVID recovery, but definitely given the growth outlook for not for 1 2 years, right? Next 5 7 years, I think this could be a very good window to build a very high quality portfolio. To conclude, economic cycle is okay. Will get better. Earning cycle is okay at this point in time. Will get better, right? So moderate your risk levels of the portfolio by investing across funds and asset category. So one of the peculiar thing we experienced in the last 2 years is people got over invested in few equity thematic stuff or category like a small cap or a micro cap. I think it makes sense given the macro environment and the numbers are there in front of you. We should allocate money across large cap, mid cap, small cap. Definitely large cap should have a lot more capital than mid and small cap. Apart from equity, there could be a fixed income, there could be a non-equity, non-fixed income, which could be a gold or some other asset class, right? So I think a good asset allocation is a need of the hour. We cannot get overboard in any asset. We strongly believe 2025 will be a very fantastic year to build a good portfolio. So this year will be a year of investing and not possibly a year of reaping, right? So you invest when there is a price in your favor, and you sell when the price has gone significantly higher and you can cash it out. I think 2025 will be a very good year to build a good high quality portfolio. The fourth and last before point is sales driver will be the biggest driver to create value. Margin expansion is not going to come easy. And finally, risk reward very favorable in large cap and selective pockets of mid and small cap, given the steep correction happened in the last couple of months. With that, thanks for the opportunity. I think thanks for patient listening. We'll be very happy to answer any question. Refrain from any stock specific, but any broad question on the market or how to think about it, I'll be very, very happy to address. Thank you. You can post the questions in the chat box. I will start answering in next 5 minutes. So the first question is, what's your view on service exports with the emergence of AI? Wouldn't depend on Indian IT go down? I think it's a very interesting question, Mr. Ankit. I think definitely AI will rewrite the business models. If you look at the market cap of Nvidia, right, which is runs into trillions of dollars, clearly reflecting somebody is gaining and somebody is going to lose out. I think it's very important to see how this will play out. A lot of Indian IT corporate head also have spoken in the last 2 weeks talking about revenue growing 2x faster than the employee growth. So it will bring a different unique problem, not only for IT as a segment, from an employment opportunity, right? So because we are a very large IT dependent urban society, and if employment growth is not going to match the revenue growth of an IT company, where are we going to find jobs? So I think it's a very important juncture. Government is very well aware. If you look at, we are not having a very bullish outlook at this point in time. Last 2 3 months, we are hardly at any exposure to IT names in terms of from the new buying. But I think given the price correction is happening, maybe at some point in time, if the risk to reward turns very favorable, right, you should allocate because their balance sheets are always good. They are high free cash flow generating business model. But definitely, you need to pencil in this risk and appropriately. A very brilliant question. Hope I answered some perspective on this. Durga, please share your sectorial preference. You state that order of preference banks. What's your view on pharma? So broadly, our major index is done by 5 sectors, right? So I'll go in the same order. If you look at banking, which is a 35% weight in any major index, I think banking will do pretty well from growth rate. I think growth rates will get accelerated. Given the correction in the equity market, I think the deposit growth will get better. So I think banking is one segment that will get much better than what the last 3 to 4 years point of view. The next big sector is IT. I already shared the perspective. The third one is FMCG. I think FMCG definitely is going through a turmoil, but it's a great industry. Now, with the consumption boost, we believe these companies did not even participate post-COVID, right? Big time, they did not rally, but they have suffered huge due to inflation. We believe few of the companies from here can do extremely well because of the price correction has been very, very brutal. The valuations are turning a little more attractive, but next 1 year outlook might not be great. But those who have 4 to 5 years, I think we are pretty positive on FMCG at this point in time. Auto is in a mid-cycle. If you look at two-wheeler, is the current fastest growing segment, but is also moderating. Passenger vehicle continues to be driven by SUV. We are yet to see recovery in small cars. Our tractor is doing extremely well. I think that's a one bright spot. Commercial vehicle will pick up. So auto is in a mid-cycle, but I think definitely EV noise is now out. EV will come, but will come at a slower rate. So those who have a very good ICE model, those who have good distribution, continue to deliver decent job, but they are not going to be high growth sectors. The last one is the pharma. It's a mixed view because I think the easy in our view because of US, right? We had a good pricing environment for last 12 to 18 months. A lot of companies got benefited. I think pharma will continue to do well, but I think it's going to be at a lower rate. We need to understand the generic drug things also is improving, right? So over a period, trade generics, which is happening in India, is going to take away 1 to 2% of your Indian IPM growth. So I think we need to be very selective. Again, it's a neutral view, neither very bearish or neither very bullish. But the good news is out of 5 sectors, most of the sectors are either getting better or the price correction have happened. So I think that's why at the broad index level, the risk is reasonably off the table to a great extent, right? If I have to see, right, if there is a 5 to 10% of a downside, the upside is far, far better. So with a 4 to 5 year outlook, I think large caps are giving a very good window, which captures these 5 major sectors. What's your view on logistics? I believe the continuation of the Red Sea crisis, Trump tariff, all that. I think, okay, that's first question, second question. So I'll answer. Logistics, we are very, very bullish. I think for a simple reason, India's 350 lakh crores GDP, if we are to go to a 1,000 lakh crores GDP, right, in next 10, 12 years, I think it's going to come from manufacturing. It's going to come from exports. Second, your DFC is going to get commissioned. So a lot of India recovery of growth will be played via logistics. And we need to become competitive in export means we have to be very, very competitive in logistics. So I think the short-term noise are very real, but definitely right in the medium term, we believe logistics are a very important segment. It will play a bigger role in India now than in the past. What's your current view on alcohol beverage, especially in terms of valuation? Currently, we are not buying any of these names. I think you rightly addressed. These are great stories, but you have at appropriate valuation. And valuation is a function of few things, right? One, the return on equity, the near-term growth, the longevity of growth, right? I think where liquor business scores very high is the longevity of growth, but where they don't score very high is the short-term growth and the valuation. So we need to play around these 3 variables to figure out which company you buy at what point in time. Next question, Dr. S. If I have 20 lakhs today, how should I be allocating, please? I think, sir, I don't think I'll be able to answer in terms of how, but broadly, I'll tell within equity, the cheapest point is large cap, and everyone should. So if you look at the entire market, right, the entire market is 70% large cap, balance is mid and small cap, or a 60% large cap. But what happened in the last few years, we see in few portfolio, I'm not referring to you, sir, but I'm sure given the broad thinking, mid and small cap has gone 50, 60, 70, 80%. Large cap is like 5, 10%, right? I think this mix has to change. We believe minimum 50% above should be in large cap. That's where the risk reward is extremely favorable. And maybe a very small portion, if you have been very selective on the stock ideas, at the fund level, you have to be very, very measured, right? You don't have to do lump sum at this point in time in a small and mid cap. Maybe a multi-asset could make a lot of sense. So I think that's how you need to consider. Have a 4-year outlook and have a reasonable expectation of 12 to 15. We are not going to deliver what we delivered in the last 4 years, right, as an economy. So your return expectation has to be close to 12 to 14 to 15. And you need to have a minimum 4 to 5 year outlook if you're coming into equity or a multi-asset type of a product. What's your thought on gold? I think gold has done extremely well. We are very, very happy to tell last 3 years, we have been having gold to all our investors, those who are part of iThought. But I think at this point in time, gold has hit yesterday, I think $3,000, reflecting the concern of the macro. But I think the risk to reward may not be very great at this point in time. You have to be very careful. But I think the trend is definitely upward, right? So that's where private large banks have not gone anywhere, can buy. I think price alone doesn't convey anything, Mr. Balaji. I think if you look at the profit pool I shared, right, in the Nifty also, all the private banks have almost doubled the profit in the 5 years. So I think over a long period, the price follows the profit. I'll tell you one. So what happened also? Why this underperformance? I think there are clearly two reasons. One, FIs were overweight on private bank pre 4 years back. So they want to reduce India weight. And I think private bank being a liquid name, the reduction of weight has happened. The last 2-3 quarters, that is coming down. Point number two, public sector banks and other sectors like capital goods, industrials did very well. So there was a natural rotation from a very stable growth private bank to deep cyclicals. But as the economy now stabilizing, people are moving back from deep cyclicals, which is capital goods, to private banks. So we strongly believe next 2-3 years, this is going to be a very interesting space from a risk to reward point of view. How much percentage should portfolio should be in gold? I think it's a very specific question. Generally, in the past, our portfolios have 10 to 15, 20%. But today, I think we are going a little slower. So it should be spoken with the your advisor. But I think gold makes sense, but at a price, right? Today, it is not an easy decision because gold has already hit all-time high. Thanks for the presentation. Thank you, sir. One of the most loved webinar. Thank you. Hope you like it. We'll continue it. So within auto, how do you see rate auto, ancillary automakers? Where do growth lie? I think auto ancillary growth now will be a function. If you look at a lot of auto ancillary, few auto ancillary companies become global in nature. And at least I can vividly talk about few corporates which has become world number one, world number two in the respective product globally, right? So clearly, 15 years back, our auto ancillary is a clear play on auto. So you can't buy Maruti, you can't buy M&M, you buy a player who supports Maruti or an M&M, right? But today, that's not the case. They both might have a very different cycle. I think that's the unique about this opportunity, right? So I will tell the auto is little more homogeneous. Auto ancillary is not homogeneous. It is multi-product, multi-country. Those who are definitely focused on Europe suffered a lot. But hopefully, we believe next 2 to 3 years, these players will come back very strongly because what we are experiencing in Europe in last 1 month is finally revival of Europe growth, which could be very, very positive for few auto ancillary companies. Can small cap correct another? Oh, it's a very tricky question. Definitely, I would say a very good correction, a good one leg of correction is done, but doesn't mean it can't correct, right? The valuation still in pockets are very, very expensive. If you see historically across India or across the world, smaller companies should trade closer to large cap or lesser than large cap, right? But I think in India, we have taken the narration so strong in the 4 years. Few small caps are trading at 60, 70 times multiple. I think definitely if you are in a wrong stock, it can be far severe than the number which you are speaking, sir. Uh, I'm part of M2W. I have some FDs that can be invested in M2 for next 5 years. Should I go immediately? So speak to our colleagues. I'm sure they will help you. If you have penchant for volatility, see, because FD is very different product to some of the options which we'll give it in M2W. But I think you should consult with our people. Our people will guide you and hopefully will allocate your capital so that you will the upcoming rewards out of corporate India's growth. Hope I answered your question, sir. How to identify good valuation stock in a large cap, sir? Wow, I think it's again a tricky, right? So every asset has a price. So you do absolute valuation, which is DCF. You do relative valuation. You do historical P, price to book. But I think you need to know a sense of finally what is the money this company is generating and how many years of that money I'm willing to pay, because that is already in the table, right? You're going to pay up. So when you pay 60, 70 multiples, you need to understand you're paying 60 years of earning today. Beyond that, only you're going to get back, right? So I think we need to be cognizant of valuation. There is no one particular tool, but definitely, if any company has a 10-year track record, Sindhil, I can at least one thing I can tell, the historical data will give you some glimpse of where this company can trade. But if the future of the business is not the same of the past, that becomes irrelevant. That is where, if you are a very serious investor who can spend 4 to 5 hours of time in a day, direct equity investing is recommended. Otherwise, you're always better off choosing a good mutual funds or maybe if needed to be a PMS if it's larger money, so that the decisions are done with a process and it can be replicated across good markets, flat market, and bear markets. Thanks for your session to ask. Thanks, sir. What's your perspective now on capital market and insurance? I think clearly capital market sun is setting. This is not the time to look at capital market ideas. Those who have been part of Solitaire or those who are part of iThought, right? We clearly reduced or sold almost every capital market idea in our portfolio in the last 6 months, saw the valuation concern. But insurance is a quite opposite, right? Because of capital market did very well, which is broking, asset management, wealth management. Insurance did so badly in the last 4 years. We are super bullish on insurance, and I think next 3-4 years, the sector will become attractive. I think we see better risk to reward at this point in time in insurance, both life and general. It's a good time to invest in insurance. I think I've answered Mr. Muthu. I think, but I'll not be stock specific. You have to be very, very clear on that. Is it possible to get this PPT? The video will be put out, sir. I think that will help you out to go back and see. Hope that helps you out. Keen to hear your views on how you foresee any potential impact of domestic market valuation sentiment as a result of rotation of global. I think all these things will happen in the short term. The good news today is prices have corrected. I look at a medium-term picture, which is a 4-year outlook. I think India growth will get better. When India's balance sheet is better, corporate balance sheet is better. So you have a 4-year outlook, all this will go off. But if you have a 3-month outlook, I'm sure these are the biggest concern. And I think maybe a different people can give a good perspective, because it's all about what time frame you're thinking. And definitely as a house, we are very, very well trained to think in 3 to 4 years, which is our broad thinking. And I think we are pretty positive at this point in time in the larger ones, as I told. Short term could be very volatile. We have to be very, very clear. Tomorrow morning, no good news is going to come. I even can tell Q4 numbers are going to be weak. But I think things will get better, because now everybody knows the corporate India numbers are weak. So that's a good news. Once the number gets better, you will see the price action will be far, far superior. Thanks for the presentation. How to know FMCG is recovering. I think the data, sir, I think you have to consistently hear to the management. You have to go into the distributor, go and talk, feel for what is happening in the economy. So there are many points. I think simple visit to a store will give you a good idea which companies are doing well. But I think we are close to the bottom, right? But I think Q4 also will be more of a weak quarter for FMCG. View on silver, very similar to gold, not particular view. As a house in the past we have played. Now we are little more, little more positive, but not super positive, I would say. Budget tax cut will benefit consumer durables. Absolutely right. We are going to give money, but this money is not going to come immediately, right? It will come as we are going to earn income, right? So, but it is going to be positive. Again, which stock, which segment, you have to be careful. We have to be very careful on valuations, right? Don't only look at the positive, which is the top line and profit. If you pay up, you're not going to make money. Contrarian sector to look at, I think a consensus contrarian is private bank. Everybody believes, but it's a consensus. FMCG looks like a very contrarian today. But I think if you step back 2008, cheap crisis, FMCG was cheap, nobody bought in. Government funded the consumption. Eventually, 2008, 2013, the best bull market happened of consumption, right? So we believe it's a one segment where you have to keep an eye open. And if the data supports, I think you have to go very aggressive there. How is the paint? We don't have any exposure. We called out clearly some time back. The competition is real. It's competitive. We are clearly seeing the market leader is suffering. It's going to be long time. So we don't have any exposure in paint at this point in time. But valuations are getting attractive. We continue to monitor, maybe at a price where the new player is going to turn into profitable or thinking about profitability. I think that's where you should look at which company to buy at what price. How is the power sector? Power sector will have good demand, but you have to be very careful. These are fully driven by government, predominantly will be far more deep cyclical. People over-invested in capex story, people over-invested in manufacturing themes, suffering in last 6 months. So don't go by narration. Have a very balanced portfolio, but I think power is one big beneficiary of AI. It's going to be an everlasting theme, but you have to remember, power is a low ROE business. So as I told, evaluation is a function of growth in the near term, growth in the long term, and return on money. I think power problem is this is a low ROE business, so it doesn't generate a lot of economic value add, so that you can't pay significant multiple in this sector. Unlike an IT or an FMCG, which is an high ROE business, and any growth recovery, the multiples can expand significantly. So that cognizant you should be aware, sir. Consumption, staples, discretionary. I think discretionary will be the first beneficiary. Staple will be a natural beneficiary, right? We are not going to consume a lot of toothpaste because we are going to get a lot more income at the bank. But I think broadly you will see some recovery in staple. Discretionary is where you will see a lot more recovery, right? Given the favorable risk to reward in large cap, selective in mid, what criteria should investor use to identify best opportunity? I think similar. I think already spoken, right? Have a very large, good portion in large cap. It could be in funds, it could be in PMS, or if you want to choose direct stocks. And mid and small cap, you have to be far more careful. It's not going to be the replay of 2020-24. All I can tell, if we are in that assumption, I think market is going to test a lot of us. Will announcement and the effect of reciprocal tax drag the index further? Possible in the near term. But remember, as long as India's EPS, India is going to grow at 10%, India EPS is going to grow. Eventually, you're buying Indian company, which is predominantly India dominated, right? So the short-term noise will give you opportunity for the long-term opportunity. Similar story happened in COVID, right? What will happen tomorrow? And everybody missed it, right? So these things will be there. It is going to be a little more challenging, no two-way about it. But if you choose 4 years clearly and allow to get out, remember one thing, you will always get good price when there is so much of confusion. If you want all this confusion to go away, don't expect very cheap price, because the cheap price is a function of the confusion, right? I think as an investor, you need to be very clear. I either choose confusion, so I get cheap price, or I want the confusion to pay 20-30% more premium. So choice is yours. And I think we are willing to underwrite this confusion given the long-term growth of India and try to buy at this point in time in large caps. What is I thought view on data and consumption sector? Oh, data is fantastic. I think data centers, we don't have any large listed company to think about it. But these are emerging sector. As and when they become stabilized with a profitable business model, we will consider investing in. A couple of our large names are supporting data centers, all I can tell. The summary mentioned in the sales will be the biggest driver going forward. What specific metric indicator should basically look for credit growth of banks, which will come out every week, every bi-weekly and monthly, and look for corporate India results, which we update every 90 days. as the sales continue to grow, right, India will continue to march upward with volatility. Do you think large cap banks and financials have? I think I already answered enough on the banks. We're very pretty positive. Growth at reasonable valuation, I think, is your core. Always, sir, growth is the key for any value creation, right? So I actually posted in my LinkedIn, if you have to go back, right? So there are companies which has not posted growth for 10 years, right? Can't create any value. So growth is a bare minimum requirement to create value. But I think in the last 4 years, people went little overboard on pay up, right? I think we need to be cognizant of how much price we pay for every asset. So growth and valuation is always a central point. You need to figure out the beautiful balance between these two to create great value, right? Thanks. Any view on L&T? Stock specific will ignore, sir. Broadly, government-related companies will go through pain before the gain. All I can tell you, Durga. Thanks for your comment. May I know within large cap which sector looks? I think I've answered enough. What about your view on QSR? Logistics, we have spoken a bit. QSR, I think outright view, we are continuing to monitor. They have done a very bad job. But the problem with QSR is, I think the industry is getting fragmented. There are a lot of new brands consistently coming in. So we need to be very careful which brand we are choosing. And sometimes our health economy also is not going to support a lot of this QSR brand. So thanks, super presentation. Thank you, sir. One question on the one hand, large cap is said to have become cheaper. Other than they say Nifty 50 is expensive. How do you understand the contradiction? I think large cap, I refer to Nifty 50 broadly got very, very cheap. Next 50, even though they are a larger company, they are pretty expensive. Now they got moderated. You have to be very selective. The broad message on the large cap is a Nifty 50, right? Because that is where we run our large cap fund, which is True Blue. They capture the 8 lakh crores of profit pool, right? So obviously Nifty next 50 is a little less illiquid, and that has created a lot of fraud. So you have to be very choosy. Couple of names have also in the past had some governance issues. So I think certain index have to be very more carefully chosen. Broadly, the larger names are far more cheaper than the mid and small. That's all, right? I'm not coloring between whether it's part of Nifty 50. Also, few expensive stock today we have. I think next 50 has a lot more expensive stock at this point in time. The growth outlook seems good for ER&D compared with automobile. Do you think is a sector to play? No comments, because I think the growth is getting moderated if you have tracked a few ER&D company. But they are generally broader growth than automobile. There are no comparison. You need to compare with IT company. They have done very well ER&D IT companies, which is basically in referring to which is doing automobile-led ER&D or aerospace. They are good companies, but at right valuation. I think they are now slowing down in terms of growth. How to learn to use forward earnings reasonably as a value investor? I think you keep tracking corporate India numbers. The way is you build your own assumptions on the growth margin and build your P&L and get the forward earnings. I think I always see there is a decent money to be made by investing into mutual fund. Keenly able to spend 3 to 4 hours in a day. This should be possible, and definitely right. There are a lot of good videos out there put out by all our colleagues, which will help you out to assess it. Thanks for the presentation. Thank you, sir. Your YouTube videos on reading balance sheet is mind blowing. What's your view on shipping sector like GE shipping with global trade? Okay, thanks for this comment. I feel very good about it. I think coming to again, no stock specific, you have to be very, very careful on particular ideas. Any idea worth the valuation, worth the growth. Definitely, it has a lot more data points to track because of its global in nature. So it is more volatile in nature, right, from a thinking point of view. Within small bank, in the long run, compared with private, since the other bank attack, and what type of a difference to big banks? I think Indian big banks are gaining market share over small banks, both on the deposit and credit. I think if you're very sharp in particular small bank, no comments, but broadly, I think bigger ones are doing much better. And obviously, right, they are easily monitorable than the smaller ones. Very informative. Thank you. Hope you like it. This will help you to take better decision. Do you suggest any websites, any stocks, research? I think the go-to site for all of us is Screener. We do use a lot of global platform, ACE Equity, all. But for every individual investor, I think Screener does a good job. A good friend who has built this platform, I would say it's a world-class platform. Gives you a very good insight into having a data in a particular format. The bigger ones can be done by institution, but I think for a good investor, Screener is a great place to start off. Uh, Suggest new webinar M2 once in a quarter. Okay, sure, sir. We'll communicate to the team. Thanks. Hope you like it. Thank you. Thanks so much. I saw your conclave. Thank you. Thanks. I think it's been was tax cut. IFMC should recover well. I think should be good. Thanks, Lord Balaji, analytical view. Thank you. I think I keep consistently believe, right? We have so much of narration. Our objective is to share the data, which will become objective way to assess the corporate India and take decisions. I think when we take decision based on keeping data in front of us, when the price action is not favorable, we can feel a little more confident because we have data to back our view. And eventually, when the price comes back, we feel very confident about the way we went about taking the decision and make good money, right? So I'm a big believer of data-led decision making, and that's an exercise which we do in iThought, and that's an exercise which I continuously do every 90 days. Hope it benefits all of you to become a good investor. Flexicap, multicap, I think all multicap, right? I think flexicap, right? Where it's you need to give full flexibility to the fund manager. I think multicap has some segmental issues, right? So, and Babu, which sector do you think I've answered the broadly with from you too? What's your view on capital market? I think I've answered, sir. Hospital, I think hospital is a late cycle. We don't believe there is so much money to be made at this point in time. The ROEs are currently stable. The growth outlook is good. So valuations are very expensive, right? So you choose, you are okay to pay super premium valuation to buy comfortable growth or pay low valuation and buy volatile growth in the near term, but reasonably sunrise growth in the medium term, right? So I always choose cheap valuation expected to improve growth and ROE, and that's the framework which I refer to it. So view on energy, I think it's very volatile. You have to be stock specific, but definitely a very important sector. I know you said today will be a very good year for building portfolio. If one has to stomach the digest probability of good time for consider portfolio quality names. 100% quality is going to come back. Large cap is going to come back. It's going to test a lot of thematic small cap funds. This is a great question, and I think that's a good right. Quality is going to be coming back because economy is normalizing. Everybody wants to own quality, but last 3-4 years, a few of the portfolios drifted towards very deep cyclical. They're going to come back into quality. Should we start? I think there is no one point. It's like a pendulum, right? Market moves from extreme optimist to extreme pessimist. I think when it gets cheaper, you need to slowly move the decision. You cannot look for one number and then say, right, I will get in. You look at, okay, right? So broad valuation for Nifty is 19-20 times. So you know when the valuation is coming in close to that range, you slowly start playing like a car. You move the gear from first gear to second gear to third gear. As you get more clarity on growth and the valuations, right? You move to fourth and fifth gear. You don't move from first gear to fifth gear, right? So that's the way I think about it. It's not about either you buy in or you don't buy in. You move gradually and you accelerate at a point where you're confident on the growth coming and valuations are still attractive. That's the point you go to fifth gear and capture the growth. Thanks, sir, Ramana, for the comments. A lot of technical course available online, but could you suggest maybe I'm not so sure, but I think there are a lot of good videos out put out by iThought and a couple of my other friends who put out videos. Hope that should help you, sir. Thanks a lot. Thanks. Hope you liked it. Can you please share your YouTube link? It will be shared in a day's time. It will help you. Good time to do lump sum. Large cap, definitely a good portion of capital can come in lump sum. The rest you can think about SIP or SDP, right? That's a way we think about it. But clearly come with a 4 to 5 year outlook and don't think tomorrow morning some good news is going to come, right? So that's my request, sir. I think to end, I think we've taken enough time to end. We are in the weak phase of the growth has been done. We believe the growth is going to get better. Valuations are favorable. Come with a 4 to 5 year outlook. I think you will not, you will make, I think, the best risk to reward at this point in time, right? Thank you. Thanks for your time. Hope to see you soon. Good day.